everyone. Thank you, Eva. So I'm really thrilled and honored to be here and being able to present you my humble views on how a risk-based approach could be applied to cryptocurrencies as a new way of making payments. And in my presentation, I will also try to share with you what I think a healthy compliance could look like. When I say to people that I work in cryptocurrency industry, surprisingly, the most common question I receive is, can you buy a gun with Bitcoin? And my usual reaction is, why do you need one? But when you think about this, as the previous speakers already mentioned, there is lots of negativity still around this cryptocurrency technology. And this negative views still prevail. And in my presentation today, I would like to address this and look at this from a risk-based perspective, because regulations and AML should be technology neutral, right? So there should be ways to look at this technology from a risk-based perspective. So what is a healthy compliance, or what could it be? In my view, it's 3 times knowledge, or deep understanding on 3 elements: on the technology itself, of course on AML rules and obligations, which we all know here, and third, to understand particular risks which cryptocurrencies in this instance pose or are vulnerable to. And only then, having this deep understanding, we can apply risk-based measures. So this is the second part of healthy compliance. And it's from the entity point of view. But entities do not operate in a vacuum, right? So we need a measured regulatory environment. By measured, I mean that we need our country laws be enabling for us to do risk-based compliance. So they should be allowing it and should not be that much tick-the-box principle or prohibitive. So all this, talking about regulation, all these discussions going on in the world about how to tackle cryptocurrencies, how to regulate them, they kind of combined into a general approach that, of course, AML and CTF should firstly apply. And then, of course, there are tax laws, and some countries choose issue specific laws to regulate this new technology. However, today we talk about AML, and of course, FATF is the main standard setter, who issued his first guidance on cryptocurrencies in 2014-15, and in 2019, June, they issued a new version of those guidance, which I will address shortly. And all this, in the middle of all this regulation, stands risk-based approach. So that's why I'm addressing it today. Many of financial industry compliance officers know this very good. However, in practice, it requires to go into details, because the devil sleeps in the details, right? So what the 2019 guidance said, it said many things. For those who haven't read it, I truly recommend it to do this. But what I want to stress on is that FATF itself said that cryptocurrencies are not necessarily high risk. So, and this is a big step forward, we think, for cryptocurrency industry. Finally, the standard setter recognizes it. So finally, there's a room for technology neutrality, which everyone talks about. So countries should not necessarily put high risk on cryptocurrencies and cryptocurrency service providers, but they should rather assess, evaluate case by case, gather data, and base their decisions on quantitative and qualitative information, not just out of personal feeling about the technology, right? And the second thing, which relates to what my previous colleague was talking about, FATF clearly says that it does not support de-risking. So this is also good news for not only for cryptocurrency industry, but also for other fintechs. We hope that this big action from regulators, from standard setters, will move the huge ship of de-risking towards other direction. So to go into my presentation, it will address not the general AML obligations, because I'm sure everyone here gathered knows them already, have heard them many times. I would like to focus a bit on technology itself and a bit on particular risks the technology poses. So understanding the cryptocurrencies, we first of all need to understand why they were invented, after all. So the concept was very simple. It was an idea to create peer-to-peer transactions, and this way to reduce costs for consumers, avoiding intermediaries, such as banks, financial institutions, or others. So this is important to understand for compliance office, because what this means, it means that cryptocurrency transactions can happen peer-to-peer without any of us participating in it. And they will happen, they do happen. So we have to be careful when thinking about how high to put the burden on the customers of providing all the KYC information, all the documentation we ask, because if it's too high, the burden, they will not bother and just go do it peer-to-peer. And with that, law enforcement will lose any track of and any source where to get KYC information, such as at the regulated exchanges, for example. So there are many cryptocurrencies in the world. It's about more than 2,000 of them. Of course, none of them will stay here tomorrow. Some of them are very new and will not gain wide adoption. But Bitcoin is still dominating the market in total market capitalization. And that's why I will focus more on Bitcoin, Ether, those cryptocurrencies which are mostly widely adopted and which are based on public blockchain. Because as you will see very soon, each cryptocurrency can have so many technological differences that what I've said to you today will not apply. So how do those transactions work? As I was mentioning before, peer-to-peer transactions happen without any of us knowing it. So any of you, me, your mom, can download a software on its computer, on his or her computer or phone, and generate a cryptocurrency wallet. And that's what is needed for them to receive Bitcoin, Ether, or whatever wallet they have downloaded. The same goes to the recipient. So I can send these transactions freely peer-to-peer. Bitcoin network, decentralized Bitcoin network, approves the transaction and it's done. 10 minutes and it's done. How the regulation can come into play? Because we cannot regulate these peer-to-peer transactions. You cannot say to each of the 7 billion men and women in the world that they cannot use some kind of technology, right? It's free, it's open source, so they can just do it. What regulation can do and what it does, it finds the entry points to where cryptocurrencies try to touch fiat market. By fiat, for those who haven't heard, I mean traditional money, US dollars, euros, etc. And usually clients want to exchange the cryptocurrencies to euros at some point, or buy cryptocurrency by paying in euros, so they enter a cryptocurrency exchange. And by entering it, they usually open a cryptocurrency wallet at the exchange. And there's a difference between private wallets I've showed you before and the so-called custodial wallets or hosted wallets at the cryptocurrency exchange. The main difference is that in the first scenario, the user controls his private key, and the private key means that he controls his assets himself. So he has to safeguard it on his own computer or wherever he has it, and take care of security measures himself, so that somebody does not steal his private keys and does not take control of his assets. In custodial wallet scenario, these private keys are kept by the custodial wallet provider. Is it an exchange? Is it maybe just a custodial wallet provider? Depends on what user has chosen to. So these intermediaries now we are talking about are regulated. They conduct KYC before opening an account for those users, and if user wants to transact, to send Bitcoin to another user, which might also be at another cryptocurrency exchange, not at the same exchange, he needs to initiate this payment like in the bank, it would do, or in traditional financial institution. But authorization of this transaction happens at the exchange level because it has the control of the keys. So this is basic what we need to understand about technology. And when we talk about AML, is it the same old AML which applies to cryptocurrency industry? Yes and no. Of course, all the same obligations apply, and I will not go into detail about it, but we need to understand specific risks which rise from the technology, and that's where I'm going to focus right now. So I would suggest to look at this from 3 angles, at the risks, particular risks that the technology poses. Different coins or different cryptocurrencies pose different risks. Different market participants pose different risks. And then at the end, when we monitor transactions, there are different suspicious criteria or suspicious scenarios which need an understanding in the technology itself. So when we talk about different types of cryptocurrencies, they are prone to different vulnerabilities, or the level of vulnerabilities is different. Let's say if we compare Bitcoin and Monero or Zcash, which are also called privacy coins, and Bitcoin is on public, transparent blockchain where everyone can view the data through all the chain of the transactions to the Genesis block. So with Monero and Zcash, it's not possible because the cryptocurrency itself employs different techniques which obfuscate this trail of transactions. So of course, if you're a compliance officer looking at it, those types of coins would pose more risk to compare with blockchain, public blockchain-based cryptocurrencies. Different market participants pose different risks. So there are many market participants in this cryptocurrency ecosystem, from miners, from, of course, peer-to-peer investors. But I will focus on a few of them which need maybe more attention in terms of AML risk. So most of you have heard about Dartmouth Market. So this is the place, a market, where sellers of illegal goods could meet the buyers which are in need of those, and this is where you could buy your gun if you need one. So administrator of this marketplace is a risky market player. So if you are a compliance officer and see in your investigative efforts a tie to Dartmouth Marketplace, so you would need to take a closer look, to take a look whether it's your client is directly connected with this Darknet marketplace, whether there are indirect connections, and whether those connections broke somewhere. Because although cryptocurrencies allow you to look through the chain of transactions, sometimes it's not possible to assume that all the chain, so that your customer is connected to with all the transactions throughout the chain. Another market participant which is risky is peer-to-peer exchangers. And this is a difference from exchanges which are to become regulated in a few months in Lithuania, right? Peer-to-peer exchanges would usually be private persons which would advertise the services, come meet me, I will exchange your cash to Bitcoin, or vice versa. And you can find those ads on Facebook, or this is an excerpt from Skelbilt. So this is happening, and if you are a cryptocurrency business and look at your customer base, there are some suspicious scenario indicators where you can find such kind of actors or suspect that they are doing this and investigate it. Exchanges are big market participants. However, exchange risk differs from exchange to exchange. And this is to understand that not only legal laws which apply in the country where the exchange is operating is something to consider. We need to look at the exchanges that they sometimes do more than the law requires from them. Sometimes they have very good AML, CTF, and fraud prevention mechanisms just because they want to safeguard themselves from the crime, right, and the fraud, and to be able to maintain banking relationships. So this is not what we look at, but we should look, maybe there's intelligence, open intelligence, that this exchange does not cooperate with law enforcement, this exchange knowingly facilitates crimes, etc. So this is what we call a high exchange, and an example here is BTCE, which was seized and closed, and their owners prosecuted for operating this kind of exchange. And the fourth market participant is Bitcoin ATMs. So this is a machine where you insert your cash, put your cryptocurrency wallet address, and it converts your cash into cryptocurrency and sends it to your wallet, or vice versa. Again, not all cryptocurrency cash machines are risky. It will depend who operates them, whether those who operate those machines apply any risk mitigating measures, whether they maybe introduce KYC procedures, they collect IDs at some point, and maybe they have limits for transactions, etc. And the third angle is suspicious transaction indicators. There are many, and this is not an exhaustive list. I will not go into details here, but for those who are interested, will have an opportunity to see it in my slides, which I will share with you. And for the end, I would like to focus a bit on a few issues which are making life hard for those market participants which are compliant and want to be compliant. So the territorial application of AML laws is a pain. So we do not have this possibility to apply passporting as banks have or EMIs have. And it means that you have to think of how to comply with all the different jurisdictional laws in which you want to offer your services. Application of new laws on existing customer base is a huge thing right now, because we are debating these new laws are coming into force, and we are a business standing for maybe 7 years, so we have a legacy, right? And what should we do tomorrow when the law comes into force? So the laws should give grace periods for existing relationships in order not to put businesses in a situation where they just simply are not able to comply. GDPR versus AML, of course, everyone knows that KYC questionnaires, they got longer and longer. We want more and more information. And GDPR says you have to minimize your information. And if you want to be a compliant exchange, you need to comply with both. And where's this balance? And one regulator wants this, another wants that. It's quite hard to prove your legitimate intent on collecting all this loads of information. And instead, when you could maybe look at what you already have in your database and work on it with sophisticated tools. To serve or not to serve is a question we all face, I guess. And in my opinion, to avoid history of de-risking repeating itself in this industry, where cryptocurrencies exchange will be forced to say no to certain client groups because maybe law says so, or maybe a regulator thinks so. This is not what money laundering, terrorist financing regulation is aimed at, right? They say, do your job, identify, monitor, and then report if you find something's wrong, right? And give law enforcement a chance to work with this information. So if we say no to the customer at the very beginning, law enforcement will never get a chance to get hold of any information related to bad actors. And travel rule, just for time limitations, I cannot address it because it's a huge topic, but maybe if it's interesting, I could address it in a question Q&A session. So to end it, I totally agree that cooperation is key. Lawmakers and private sector and regulators need this cooperation at this point in time when we're creating our regulation, and also later when we share information between us and by filing STRs and replying to subpoenas and information requests. So this wraps it. If you remember anything from my presentation, I hope you remember that cryptocurrencies are not necessarily high risk and that there is a way to healthy compliance, and it is a risk-based approach. Thank you.